maybe the regional bank the stocks fell and the ETF fell as a result too much, and it's a rebound probably. But to me, it looks like a schizophrenic market where people don't know how to price in the regional bank failures.
Welcome to Gold Silver Pros.
Hey everybody, this is Rob Kientz with GoldSilverPros.com. This is your weekly market wrap-up for May 5th, 2023. I'm recording this about 2:30 p.m. Central Time here in the United States from the great state of Texas. Welcome everybody to the stream. The talk this week is going to be about the banks. I can't help it. I know we've been reporting a lot on the banks lately, but the banks are driving everything. Reported earlier this week that the regional banks were crashing down. They've had a little bit of pop today. We'll get into that news, but let's read over the general economic data first, and then we'll talk about the effect of the banking on the economy. And of course, we'll do our gold and silver report as we always do. As we look at the economy, gold is doing pretty well. It had briefly a little bit of a candle touch or a wick of a candle touch on an all-time high at 2081, although it didn't stay there. So I don't know if you declare that an all-time high, but it touched on it, meaning it's challenging the previous all-time high gold that we saw as a result of the pandemic in 2020. That's a nice rebound. Of course, gold is broken out into a bull market. It's broken out past its 50 and 200-day moving averages, meaning the price is accelerating faster than it had over the previous, say, about a half a year or so, and that's positive for gold. A lot of that, of course, has to do with what's going on in the banks. Right now, gold is trading at 2017.32, silver at 25.65. Both have sold off today exactly 1.59% each, according to the tape on goldprice.org. Now, whenever you see gold and silver sell off in tandem like this, it's basically algorithmic trading on the futures market, hitting certain price points because they shouldn't trade in tandem. Silver is more industrial, gold's a little bit more monetary. Each one has factors of the other, but they act differently. And whenever you see both the metals move it down exactly the same percentage on the same day at the same time with the same chart, you pretty much know that's manufactured by the computers. It's algorithmic trading. Looking at what's going on in the economy, it's a schizophrenic economy, hence the title of this broadcast. Manufacturing PMI is at 50.2. That is a slightly positive print. Anything 50 or above is considered positive. Well, 50 is neutral. So it's 0.2 points above positive. I don't know what to look at there because the ISM manufacturing, a similar index by a different party, is at 47.1. So depending on who you talk to, manufacturing is either okay or not okay. It's not the majority part of the economy. But whenever I look at the manufacturing data, like these various indices around Philadelphia and New York, they're all different. And there isn't consistency in manufacturing, which tells me certain areas of the economies are doing okay, certain are not. And there's still issues in the supply chain because the manufacturing numbers are all over the place. Construction spending's up about 0.3%. I don't think it really means anything, to be honest with you. U.S. job openings at 9.6 million. Those are down slightly from last month at 10 million. Getting back into labor, productivity is down 2.7%. People are not producing as much. That could be quite quitting, or it could be people just not doing as much or not having the facilities they need to do as much as companies cost cut in the economy. So, of course, that's going to reduce productivity. Labor costs are up. Wages are up 4.5%. Initial jobless claims are up 242,000. So that's more people applying for jobless claims, even though the administration keeps saying that we have more and more robust employment prints. I'm going to show you why, when you go back and look at past revisions, how basically the initial employment print in the month that comes out is a bold-faced lie. So the employment print that came out today is probably a bold-faced lie, but we're going to look at the data to prove whether I'm wrong or right, and being overly critical of the government's numbers. Continuing jobless claims are at 1.81 million, which is almost the same last month, and 1.84. So some of the people came off of continuing applying for joblessness. Either they're going to fall off the rolls, benefits ran out, or they found a job. But given the fact that we still have high amounts of job openings, I suspect the labor part of the company is not doing quite as well. We did have the ADP employment report earlier this week. It looked like a blowout number of 290,000 jobs created, private jobs, compared to 142,000 last month. That's more than double the number. The same BLS report came out. Now they're calling it the U.S. employment report, not the Nonfarm Payrolls. That's what they do when they make a big revision, because remember, at the beginning of the year, I told you they made a big revision to the BLS numbers, and they basically took all the previous numbers and boosted them up in a bulk revision across the entire history. In other words, they made a methodology change to the numbers so that their numbers would look more robust, and the two surveys they used would agree. I don't believe those revisions are accurate, but you're going to get higher employment numbers because of that going forward. So 253,000 compared to 165,000 last month. The stock market is rebounding on that. As we look at what's going on in the stock market, Wall Street gains steam, according to CNBC. Dow surges 500 points as Apple and regional banks jump. The regional banks are jumping. The stock we've been talking about on the blog, on JM Bullion, and on our channel. I think I talked about it last night on our channel, Gold Silver Pros, how we've essentially had major issues with the regional banks. The regional bank ETF, which mirrors a lot of those regional bank stocks in the US, is crashing down big time after all of the bank failures. Well, now they're starting to rebound today, and some of those under pressure stocks are rebounding today. One of the reasons is JP Morgan, who rates companies, put out a note that they thought that some of these were oversold, or too much pressure had been put on the stocks. There's a little bit of a rally based on that JP Morgan recommendation, but to be honest with you, nothing's really changed. So I'm not sure, maybe the regional bank ETF, the stocks fell and the ETF fell as a result too much, and it's a rebound probably. But to me, it looks like a schizophrenic market where people don't know how to price in the regional bank failures. Overall, back to jobs, job creation in the US is pretty good. Now, the best one was in February 2022. Recently, we had 904K print. This one's probably about just a little bit over a quarter of that, so not bad, but it's not really replacing enough jobs to make a big difference. I'm going to show you guys on screen a little chart that I think shows the truth about the numbers, and it's showing the non-farm payroll revisions, or the labor report, whatever they're calling it now. You can see there is these massive revisions after the fact, after they release the number. So they'll release the number, it comes down again. So this number that we have released now, 253,000, is probably going to come down because the last 3 months they've been revising down. Why do they do that? Their methodology is a statistical methodology. Well, it's a methodology. It's not completely statistically sound. It's a sample methodology. It's not a particularly good one, in my opinion, because as an auditor, and I'm qualified to say that, I was trained in it and did it for 12 years. I don't like their methodology, and that's why you have these revisions. And when you're constantly having revisions like this, it's reason to question whether or not the government's reporting them correctly in the first place. So the stock market will jump on these new jobs numbers, and then it'll fall when it's apparent that we haven't created that many new jobs. Looking at which jobs were created, there were quite a few at the jobs report. I think that Wall Street opens up higher, and we got professional and business services led the job gains with an increase of 43,000, healthcare 40,000, leisure and hospitality 31, and social assistance 25. Despite serious banking troubles, jobs and finance increased by 23,000. Government hiring rose by 23,000. Now, government hiring had been falling for several months until it started to rebound, I think, a month or two ago. So we're starting to see a little bit of uptick in government hiring. It says here, according to CNBC, April's upside surprise was offset by sharp downward revisions in previous months. I've talked about that. March's count was slashed 165,000. 265,000, down 71,000 from the initial estimate. February fell to 248, a reduction of 78. So they're cutting off like a quarter or a third of these jobs when they're revised, which is why I don't follow them too closely. Overall, the stock market is rebounding today, but I think probably doesn't have a real reason to hit a big rebound on the jobs numbers, and I think it'll come off probably next week, especially if we continue to get in conversation about regional banks. Bitcoin is up. It's trading at 29,451.22, up 578 points as I look at the tape. Ethereum is up to 1982.80. Litecoin is up to 88.57. All of those up on the day on the suspected end of the banking issues in the United States, which I'm not buying. Interesting note that PacWest, one of the banks talked about as being in trouble, is up 80% today. Western Alliance 53%, and Zions Bancorp 18%. Again, because JP Morgan's note that everything's okay. I'm not believing it, but hey, good that JP Morgan is. Now we're going to present and go over the gold and silver section of the report. We can see here overall pretty good volume and open interest in gold. We had a nice spike up at the beginning of May. That's normal. May is not going to be a huge delivery month. You can see here there were 123 open interest contracts left open. There were enough, however, that they could get 1,503 deliveries. So people that could take delivery have been taking delivery, and they're also EFP. So what they couldn't take delivery on the COMEX, remember, the EFP mechanism goes over to London. It takes exposure in the COMEX and goes to London and says, hey, either give me some price arbitrage there, to help me out on my position here in COMEX, or give me the physical, and that's what EFP is. So a lot of people going to get physical in other markets. Why? Because June will be a delivery month. You can see the amount of open interest. When you have this many contracts, it's a higher chance to deliver. So right now, if you want gold, you're looking to deliver in June, or you're rolling a June contract to EFP over to London. And we can see that August is looks like it's be the next big delivery month for gold, as people are starting to pile in 10,000 new contracts there. So when people are getting ebullient in gold, when you see 695 contracts come off the current month, you could say those 695 may be rolling to a new month, because it's a rolling situation in the futures market. You take a position on the future. As your futures position approaches expiration, depending on your position, you may want to renew that position again. Maybe you want to go short, maybe you want to go long again, maybe you want to pick a different month this time. But people will roll contracts. And when you see 695 coming off, but every other single month is green, that means more people in total are coming into the market. This is a flood into the market, and why we're seeing so much a rise right here with the bank failures, a rise in interest in gold. People are playing that market to hedge. Some people may be hedging their downside risk by taking a short futures contract in gold, or hedging their downside risk in non-gold positions by taking a long position in gold, and then maybe using futures and options to do that, which is why a lot of interest is in there. It doesn't mean they're going to take delivery. Remember, COMEX is mostly not a physically delivered market, unlike the Shanghai or the Dubai market. Pretty much is a paper market, but there are some deliveries on it. So we cover both. Looking at the price data, this is as of Friday at 1:32, about an hour ago. It's nice that they printed that for us. Most volume, again, was on the June contract for gold. 251,073 contracts have closed so far today. Gold's trading down $30.90. 2024.80 settling so far. Thursday, it was up 18.70 to settle at 2055.70 on the dominant month on June. 311,000 contracts. Overall, gold looks pretty good. Looking over at silver, looking at volume, silver volume has spiked a little bit at the end of April as there was interest. So far at the beginning of May, not a ton of interest. We did have a little bit of delivery 26. This is a really small month for May. As you can see, only 822 open contracts here. The big delivery month for silver is not June like it is for gold. I believe it is for gold. It is June. That's a dominant contract month for June. It's not for silver. For silver, it's July, and it's 125,000 open contracts. Again, you can see 38 contracts come off of the May, or 38 open interest come off of the May contract month, but the rest of it's green, so more people are coming in silver too. So people are coming into gold and silver in the futures market to hedge their risk because of what's going on in the banking sector. EFP's of 15.95 in silver. Remember, this is 5,000 ounces of silver, 5 1,000 ounce contracts. That's 1,595 of those contracts. That's a lot of silver moving to London. In fact, let's just do a quick calculation here. Why don't we just do that? We're going to multiply 1,595, this EFP number, times 5,000 ounces of silver. There was 8 million ounces of silver interest that went over to London market so far based on trading. People are looking for delivery or maybe some price arbitrage. 1,861 contracts yesterday. This is Wednesday's data. Sorry, a day and a half ago. Again, on 120,000 contracts. You're seeing people come back in the silver market to play it. We've got early Friday trading data and pricing data on the CME Group website there. We can see so far, silver's trading down about 30 cents in the dominant contract in July on the strength of 64,000 contracts. Not the biggest contract count, but it's pretty big. You can see yesterday's more trading. So Friday's going to be a little bit light. Let's go ahead and look at yesterday's data to see what's going on. We had in July 73,180. Settled at 26.22, up 54 cents. So again, silver schizophrenic, trying to figure out what to do. And that's normal for silver. It follows gold. It does basically what gold does. It trades as an industrial commodity most of the time and then follows gold as a monetary commodity. One gold pops. Silver's not quite there. Loading the commitment of traders report. This is for May 2nd, 2023. You can see I'm right on the CFTC government's website. This is the latest. We're going to go down to silver. This is a report we look at. It's tabular, busy to the eye. It's hard to look at, but I'll highlight some things to help you out here. But just watch this every week. And once you look at these tables a couple of times, it gets a lot easier. In fact, let's just highlight the whole silver table for you guys right there. This is silver. We're going to be looking at this area. This is as of May 2nd. You can tell that the biggest movers on this were 1,586 contracts dropped long by the swap dealers, making them net short adding the 9/11 in of 2,400. So they moved net short of 2,400 contracts, the bullion banks did. The managed money went long, basically taking the opposite side of the bullion banks trade there, and only dropped 56 short contracts. Not a lot going on in silver in terms of overall positioning, but I'd like to point out that the managed money is bullish to silver almost 2-to-1, by about 1.8-to-1. The other reportables, which are the wealthy family offices, are 2-to-1 bullish on silver. The swap dealers are about maybe 1.5 or 1.4-to-1 short or negative on the price on silver in the market. And of course, the producer merchants will be, because they're protecting their downside risk, because the producers make it, and that's where they hedge. So that's not abnormal. Looking over here at gold, again, same time frame. Look and see what's going on through May 2nd. This is old data. It's published in arrears, which is why we're not getting the 5th data, but at least we get it in the last few days. Overall, what I'm seeing here is the managed money. Ooh, this is a big move in managed money. This is managed money. This is long and short. They went net long to the tune of about 11,000 contracts. They're going long gold. Looking over here at other reportables, it was almost net even, short about 500 contracts net. The swap dealers, of course, went short about another 500 contracts net, and the producer merchants went short about 500 contracts. So it looks like everybody went net short, except for the financial types, and the managed money went long. Of course, I expect range to gold trade down a little bit because the big banks are shorting it, and we got a little frothy and got really close to the all-time high. So I expect that the gold to kind of trade off a little bit, and silver too trade off a little bit, until we get another impetus for gold to re-challenge the previous all-time high of anywhere about 27.5, 2080, depending on the chart you look at, in that range. So when we get to that point, but I think it may take another bank failure, another negative news event. So I think you're going to see gold and silver probably range trade fall back just a tad here until the next big news cycle event happens. We're going over to London, the 𝘬𝘃, and it looks like we're holding steady, and gold stocks and silver stocks increased slightly. I think I've actually reported this in previous weeks, but I wanted to put it back out there again for because I don't report on this every week. I looked at Shanghai, not a lot going on with that day report. We've already read out the March data, so waiting on the updated data there. We'll get it probably in the next couple of days. So next week, we'll read out the Shanghai report and tell you what's going on there. Just as a general rule, Shanghai right now in that market, about 70+%, I think it's 75%-ish of contracts of gold are delivered, which is an exorbitant amount. Means most contracts are actually delivered for physical over there. Silver, it's running 17 to 20% on average for the year. So silver is being delivered in China, but mostly gold. China really wants more physical gold than silver. That's a clue about what China is doing with their internal system. As we have bank failures, they're gobbling up the gold. Not only is the government gobbling up the gold, their state-owned agencies, individuals as well, because they encourage their individuals to buy gold to keep it in the country, and they need that domestic demand to keep that gold in the country. Looking at gold on the depositories, here's the COMEX depositories, net, an increase in gold. Not a ton. If you go down and look at the charts, a little blip. Like if you look at the ETFs, if you look at COMEX, we'll look at COMEX total. Sorry, I clicked on the wrong one. If we look at COMEX total on that chart, you can see that COMEX total gold has fallen down. Now, it's not as low as it was in the pandemic. There definitely was a lot of gold that flowed in during the pandemic. It sold because gold went up, and so a bunch was sold in the market, and it's kind of drifted down. Even though gold price is going up, you're getting a little bit of reselling and a little bit of gold coming back in, which you see here on the chart in this green. This green right here is represented by this here. Overall, you can see it's a blip on the chart, though. That's why it's good to look at it both in tabular and graphical format. Overall, in the ETFs, most of this is stored in London, some in New York and other places. This gives us a good idea what's going on in London, and net, we're up, about 1 million ounces. Not too bad. So not too bad in terms of that. If you go over to silver, look at the same thing. Let's look at total silver on the COMEX. You can see it's fallen down. This is silver squeeze. It's fallen down. It's not come back up in terms of total ounces. Ounces are not coming back onto the COMEX and silver. The overall value is rising only because the price is rising. If you look, basically, what I look as the proxy for London silver, which is the ETF, the SLV, because that's the biggest one. You can see it has 466 million ounces to the tune of $12 billion in silver. We look as a proxy because most of this, except for one location in New York, I think most of this is stored in the UK. So you look at that, and again, since silver squeeze, they've lost silver. Valuation's gone up at the silver they have, but they've lost it. And overall, if you're looking at the COMEX, man, silver has been flowing off for the last 4 weeks, and silver has been coming out. This is what happens with industrial demand. The reason you see such a large negative red number here is because silver is demanded industrially and as money, and all of that's coming in. Gold is net positive because it's mostly money. And so people are buying gold, but there's more circulating around because not all of it's been used in industry. So the tale of two markets, if you will. Overall, that's basically going to do it for the report. I'll give you a quick summary. Banking sector causing lots of stress, causing schizophrenic moves in prices. Volatility goes up when you have problems in the banking sector, not only in banking stock valuations, but in valuations of companies like Apple and the stock market in general. We had a nice pop today in the stock market. Maybe there had been too many boo birds selling the stock market before and a little bit of a rally, but I don't see this as a bull market rally for the stock market. I see it as a weak rally because the banking system problems have not been solved. Gold and silver doing okay, but now they had that nice big pop. Now they're going to come back down. That's normal. It's consolidation phase. It could drift down maybe into the high 1800s, mid 1900s, and kind of stay there for a while until the next big news comes out that pops gold again. Because it's trading the derivative market, don't let that fool you in the physical market, though. All reports are the physical market is very, very, very strong. So if you want to get your gold and silver, you're going to want to do it pretty quick. We've had some big orders, or some people inquire about some big orders for us, as well as other people I'm hearing. So I think precious metals are starting to move pretty quick. And we'll continue this next week with the next weekly market wrap-up. Stay tuned right here to this channel. More content is below. Till next time, this is 𝘺𝘀𝘾𝙊𝙀𝙀 of �GoldSilverPros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.